Welcome back to Making Money. It's been a very strong second quarter earnings season so far, with NVIDIA results still to come next week. In just the last 5 months, we've seen corporate revenue growth of 15% compared to the same time a year ago. To help us understand the drivers behind this pretty positive trend, let's welcome Bill Davis, the portfolio manager for the Hennessey Sustainable ETF, ticker STNC. Bill, welcome. Thanks for coming on set with us today.
Thanks for having me.
Look, even as investors deal with spurts of volatility, corporate America, their balance sheets, their earnings potential, that keeps getting better. Why is that? How are they able to navigate high interest rates, high oil prices? How is corporate America so strong?
Tariffs also. No, I mean,
that too. Well, now some of the refunds are coming in, but yeah. Yeah,
so I think, well, first of all, Q2 is a fantastic story. Earnings are up, I think, 27% over the same period a year ago. I mean, it's an incredible success story. And
it's remarkable. It's surprising.
Yeah, yes, it is surprising. And one thing that's particularly great about it is that it's not just tech. It's broadening out, so there's more breadth in the market, and that, of course, is a sign of a healthy, hopefully enduring market. But and it's industrials, it's financials, it's utilities. Mm-hmm. There was record earnings everywhere. However, the other side of it is that if you think about over the last 18 months, half of the growth in the GDP in the U.S. is basically data center spending.
I know.
So on the one hand, it's good. On the other hand, I think is a little bit scary because there is so much concentration at that end that if anything goes wrong, it's going to really have a profound effect.
I'm glad you used the word concentration, because there's been $500 billion in AI-linked bond issuances this year. A debt problem, a risk problem, or a concentration problem, because everyone's trying to keep up here.
Yeah, and it's actually a little bit worse than that, Lauren, because then there's all the debt that's actually being issued by companies like NVIDIA, or I should say promised to be issued by companies like NVIDIA in exchange for orders. So there's a lot of circular debt that is taking place sort of up and down the supply chain within the IA build-out, and I think
But what are you supposed to do? Just do nothing and not invest in the future? You have to find a way to do that.
I think you got to be picky about where you go in that sort of, in the supply chain of AI. I think our perspective at Stance Capital and for the Hennessey Sustainable ETF is that there's going to be winners and losers, mm-hmm. just like with the build out of the internet, right? I mean, everybody remembers Google, not everybody remembers Netscape. And so there's going to be companies that prosper through this, and I think there's going to be a bubble, and I think at the top, the cloud end of the bubble, or the cloud end of the supply chain, which is all of the big hyperscalers. Mm-hmm. I don't see this ending particularly well for investors there, because I just think it's unsustainable. And the other point I want to make is that if you think about bubbles, it's usually one of three things that happens. There is an overbuild out of real estate, or an overcommitment to real estate, or there is tech exuberance, or there is loose money. This has
all three.
All three.
So when is this bubble going to burst? Because you've been bullish on this program. Has that just changed?
Yeah, yes, it has changed. I think we're initially bullish at the hyperscalers themselves, the big cloud companies. We don't own any of them now, but we are actually bullish on chips, and specifically AMD and Intel. And what and obviously today has been like a terrible day, but I think it's a buying opportunity, because the demand for those chips is the order book is going out into 2028 and 2029. And it's not just being fueled by the data centers, it's being fueled by normal just normal reorders and technology upgrades and laptops and phones. IoT, I mean, you can't buy anything today that isn't smart. Like even
I know, I keep searching because I don't want to hook everything up to an app or on my phone.
It's hard.
I'm old school.
I know, and
you go to buy a toy, and here's the app for the toy. No, thank you.
Yeah, and then the other point I would make about I think AMD in particular, but it applies to Intel, is AI is moving from sort of training-based models, which is basically absorb everything that's ever been written or printed, and load it into this thing, which is incredibly sort of intensive, right? Processing intensive, into more inference applications, which are much less process intensive, but they require,
More
guess
memory.
what? A different chip.
Oh.
Right. And so AMD and companies like AMD and Intel are moving into that area. And then, of course, you've got kind of at the back end of this, you also have robotics, you have quantum computing. All of these things create demand for hardware. And so we're very, very bullish on the hardware.
Let's talk about industrials quickly. You like Nucor, Grainger, and Jabil?
Yeah. I'll start with Nucor. Nucor, you know, the Hennessey Sustainable ETF is basically what it sounds like. We invest in companies that are being thoughtful around ESG issues and have strong underlying fundamentals. I get a question a lot, which is, why, if you're all about sustainability, are you investing in a steel company? The answer is, number one, we need steel, the same way we need silver to be mined out of the earth. I mean, these are things that are absolutely essential to civilization. And in particular, Nucor is the largest recycler in the United States. They recycled 22.5 million tons of scrap steel last year. And the technology that they use to essentially melt that scrap and convert it into milled products is 70% less carbon intensive than traditional blast furnaces. So it's a really good sustainability story. It's a well-run company. It's got a big moat around it.
Quickly do Grainger for
Sure.
us.
It's been in and out of our portfolio forever. It's a well-run company, strong earnings, strong sales growth. Through multiple management teams. It's just, in my view, kind of a well-run, kind of a boring compared to AI type
Boring
of company.
could be good.
Boring's
Boring
great.
is stable.
Yeah.
And quickly on Jabil.
Well, Jabil's a bit more into the AI trade.
Right, that's what I was thinking.
So,
Jabil circuits.
Yeah, it's circuit boards, it's engineering,
Yeah.
it's product development, it's global supply chain
It's down
logistics.
8% today.
Yeah, so we like that company as well.
Bill Davis, thank you very much for joining us. And still to come.